Hi, this is Mr. Guy, and we're going to be talking about monetary policy and how monetary policy affects gross domestic product. And we're just going to learn basically the basics about monetary policy. There are three tools of monetary policy, and this is the reserve requirement, the discount rate, and open market operations or buying and selling T-bills. And think of a T-bill as like a big savings bond. And what we're trying to do is change the money supply and actually make people borrow more money or borrow less money. And if people have more money to borrow or less money to borrow, then they can spend more or less money. So the idea is basically if you give somebody a credit card, they're going to spend money at the store. If you're going to give people a car loan, they're going to buy the car. If you're going to give them less loans and less credit, they're going to buy less money or buy less things, so they'll affect the economy. So when we increase or decrease the money supply, we're changing the amount of money people have to spend, and we're increasing or decreasing C in the GDP formula. There are two basic policies for monetary policy: loose monetary policy and tight monetary policy. Loose monetary policy is used to fight unemployment or increase GDP, and will eventually, after a long time or after you're doing it enough, will lead to higher inflation. To increase GDP using monetary policy, you would lower the reserve requirement, you would lower the discount rate, or buy T-bills. All of these would make borrowing easy, decrease interest rates, and increase the money supply. Tight monetary policy is used to fight inflation or lower GDP or lower the debt and will lead to a recession eventually. One would need to raise the reserve requirement, raise the discount rate, and sell T-bills. All of these make borrowing harder and lower the money supply. Loose monetary policy is characterized when borrowing is easy, interest rates are low, and money is available to obtain. And when borrowing is easy, consumers will spend more money. They go to the stores with credit cards, car loans to buy cars, spend money with credit. And when people are going to the stores buying things, businesses expand with more sales. And then with more sales, these are the things that happen to the employees and to basically jobs. Businesses will add hours. After they add hours, then they'll give overtime. And after overtime gets too expensive, they'll hire part-time workers, and eventually they'll hire full-time workers. And then at the end of the year or even longer, they might give raises to employees as profit increases. When employment increases and business hires part-time workers and then full-time workers, this means unemployment is actually going down. And then consumers will spend more money when they have jobs, they have raises, they have more hours. This fifth, consumer spend more money, it is there, it's one of these steps, and it actually is the good kind of spending more money because they actually have more money in their pocket. Loose monetary policy will eventually lead to inflation. Loose monetary policy is used to decrease unemployment or fight unemployment or to raise GDP. Tight monetary policy looks pretty much the exact opposite. It's where borrowing is difficult, consumers spend less money, businesses postpone expansion, unemployment increases, and people spend less money. And when all of these things happen, interest rates will actually increase, and it will slow down the economy, spending will go down, and then prices will go down. Tight monetary policy will lead to a recession, and we use this policy to fight inflation, decrease inflation, lower GDP, or actually lower the debt. So these are the different types of policies: tight monetary policy and loose monetary policy. And these are the three tools of monetary policy, and we'll go into each one in a separate slideshow, and we'll go into each one in more depth and show it how they increase or they decrease GDP and C. So if you have any questions, post the questions, and thank you for listening, and we'll continue on to the next one.